The wonders of technology. It brings us wonderful things, but sometimes it can be perplexing, to say the least. But nonetheless, at least we've got the ability to share my screens and you folks can hear me. I want to thank Larry and Michael and the rest of the team at the Opportunistic Trader for inviting me to come and speak today. Greatly appreciate that. A little bit of background on me. I don't know if Michael did an introduction, but I'll keep it relatively brief. I've been a trader going back to 1995 when I got a job as a proprietary trader and on the sales and trading desk for FX and fixed income with Standard Chartered Bank. And I've basically been involved in the markets ever since. My main business is providing the research and analysis, and I've been doing that for many, many years. Like all traders, you evolve over time. I would consider myself a swing trader, and everybody has a different definition of what that means. But most of my trades last on average, several hours, maybe several days, and sometimes maybe even a couple of weeks, depending on how the market's playing out. My main focus is the major asset classes, the S&P 500, 10-year notes, the G10 or the major FX pairs, and then of course, the broad-based ETFs. And on occasion, I'll do some special situations in terms of stocks, maybe from a valuation perspective or a technical perspective. By and large, my analysis is rooted in technical analysis, but there is a fair degree of quantitative and fundamental analysis mixed in as well. So I don't want to bore you too much with all of those details, but I at least want to provide a context as to how I'm going to be coming at you here this morning. And I think given where the markets are, specifically FX markets, and I'm going to get to that in just a moment, markets are actually at a very interesting juncture. They've been trading really well lately, at least in terms of the S&Ps and the 10-year notes and some of the individual stocks that I'm following. FX markets, they've been they continue to be very choppy. I had been coming into this week with a dollar bearish perspective. Certain levels had been taken out, and it looked as though that break, in fact, I'll pull up the chart. Why don't we just start with the dollar index and kind of get that one out of the way first, for lack of a better. So we'll go to a 4-hour chart. Again, but my technical analysis approach is, as you can see, rooted primarily in Elliott wave, in Fibonacci. It's not the be-all and end-all for what I do, but it's certainly a big component of it. For me, it provides a very objective framework, contrary to what a lot of people think about Elliott wave. It is objective to some degree. Every analysis approach on a technical perspective has a degree of subjectivity. So to say that Elliott wave is very subjective, I think, is a rather unfair statement, but that's neither here nor there. What I've been looking at, or what I had been looking at on the dollar index, is as follows. And I've changed the wave count as of this morning because of what happened overnight. But originally what I thought was this August 15th high had resulted in a 5-wave move lower. We had a modest correction in what I had labeled at the time as wave 2. And then we kind of got goofy. We got into a situation where price action was not overly impulsive. There was a lot of overlap between the up and the down moves. That raises some red flags. And then for the last couple of weeks, we got into this very, very choppy zone. But we did not get back above this break of the 94.40 area. And then on the Fed meeting yesterday, we shot lower. We were trading down around 93.95. I was like, okay, great. Finally got the catalyst in place to get some downside momentum going. And then lo and behold, as we were all asleep, at least of those of us in the North American markets, prices moved back above 94.40 and look poised to, and I want to get rid of this 95.01. That has no relevance as to where it was. We're kind of back into what I told clients today. I don't know. And I think that's a very important lesson, because a lot of times newer traders especially, they think there's always got to be some clear trade or some clear forecast that's in play. And the fact of the matter is the markets don't work like that. They're not there to serve us up opportunities when we show up at our desk each day. The most successful traders I know are those that are patient and selective, because we have to work with what the market gives us, not what we want the market to do. And for me, at least, as I look at the FX markets right now, and I'm not saying I'm 100% correct, because there very well might be somebody out there doing very well in recent weeks trading FX. But for me, it's been more of kind of, please show me what you plan to do. I think we're going lower, and then I will play accordingly. If I had been actively trading over the last 2 weeks, 3 weeks, based on my trading style, probably would have been chopped up pretty badly. So for me, no trade is a very good trade. We were long the Aussie dollar coming into yesterday. We'd been long it for a couple of days. Well, actually about a day. We got long it on Tuesday evening. We got stopped into it. We had a buy stop order at 72.85. Closed it this morning when obviously the dollar index moved higher, and we didn't even let our stops get hit. There was no reason to. It was obvious that the trade had broke down, and I can review that with you folks in a moment. But my point is on the dollar index is that I don't really know right now. My best guess, and it's okay to say that as a trader, my best guess right now is that we've got some sort of a complicated or complex correction going on that could easily take us back to this high here, 95.75, perhaps even a little bit higher. Until I get some clarity, I'm happy to stand aside and kind of take notes on the sidelines and come up with a good trade plan accordingly. Now, luckily, given that I look at a variety of asset classes, but I still keep my focus very narrow, the S&Ps and 10-year notes and the QQQs are providing us plenty of opportunity. We're coming off a string of trades in the S&Ps where we've been very bullish. I happen to be short the S&Ps right now as of last night, and I added to it this morning because it looks as though, I'll pull up my S&P chart, it looks as though, although it doesn't look like that right now, I'm going to break it down to an hourly chart. We had this big spike lower yesterday on the Fed. I sold into this little rally overnight. Prices went back to a new low. I added to it today. I've got an average entry of 29.18. We're currently at 29.27, so about 9 points out of the money. And stop losses at 29.36. I might be wrong on this trade. I don't know. But to me, the way I interpret this chart is that we probably have a little bit further to go in this correction. Right now, it doesn't look that way, but anything can happen. So I'm projecting, at least based on the way I read the charts, we could probably get prices to drop to around 28.90. I'm overall bullish on the S&Ps. By being short here is not indicative of my overall view, but on a near to short-term basis, I'm more than happy to try to play this one to the downside. As of right now, it's not working. But that's trading. If I end up taking a 10-point loss, or I'm sorry, a 18-point loss, well, that's fine. That's part of trading. That is a small portion of what we've made by being on the long side in the S&Ps over the last month or so. So we might give back a little bit as we round out the month of September, but September has been a great month based on that. So I know I can't hear anybody. Michael, if you're here, if there's anybody typing any questions into the chat box, if you want to relay those to me via text, that would be great. I don't want to be continually talking and not addressing someone's question, and or maybe if they're needing a clarification. So that is the way I'm looking at the S&Ps right now. I would actually be assuming that this forecast plays out, and it's looking obviously a bit dubious at this time, but if prices were to reverse back down lower and head down into this presumed support zone, not only would I look to be covering the short, but I'd then be looking for evidence that prices are set to move higher. And you might ask, okay, well, what do you mean by what's the evidence that prices are looking to move higher? Well, first of all, I never put myself in a position where I'm trying to pick a bottom or a top, or rarely. Once in a while, I will do it. But like Warren Buffett said, bottoms are more fun to look at than to pick. And I think that's a great analogy. And I also think it's a great point to discuss briefly, because there's this desire this compelling desire to want to pick tops or bottoms. I get it. You pick a top or you pick a bottom, you have the best entry point possible, and you do get usually a pretty solid reward. The problem is you have a very low win-loss ratio. And again, for some people that works out just fine. It's simply not my trading style. I'm of the mindset of prove it to me. I might have a thesis, and in this case, I'm expecting a move lower into support to hold, and then prices to move higher. That's my thesis. I want to let the market see if it supports that or if it confirms that. So let's assume that the prices do turn lower, and that would certainly be nice, because I don't want to take a 18-point loser in the S&Ps, but if that happens, that happens. But if prices move back down towards 28.90, I will certainly be closing out the short. What will be the evidence that I would look to get long? It would basically be after the market proves to me that that support level is being respected and recognized. So from an Elliott wave perspective, I'm going to want to see an impulsive move higher. So in 5 waves, or if you're not an Elliott wave person, just some very bullish candles or bullish bar formations that move higher off of that support level. If I see that, that gives me conviction to say that the market is resuming the overall trend, which in this case is clearly up if you look at the trend going back several weeks. Then what I would do from there is I would simply say, okay, I will buy the next little pullback of this initial thrust higher. So basically, I'm always in the prove it to me mode. I have my thesis. I'm not reacting. I'm saying, I think we're going to rally from here. And if we do, I want to be a buyer of the next pullback. So I always have my game plan. I always have my levels in advance, knowing where I would like to be out of the trade, having a decent idea of where prices are likely to go, using Elliott wave and Fibonacci to kind of project where those prices are going. And then once the trade's on, basically monitoring the price action to make sure that things are unfolding the way you wanted them to. And if they don't, you adjust accordingly. So let me take a look at my phone here. It's been going off. It looks as though there might have been a couple questions in here. So give me a moment here. The question was, what's your downside target in the S&P? Well, I think I've already reiterated, or I've already stated that my downside target, at least based on this particular trade, is heading down towards 28.90. Maybe we get down into 28.70. So I would say this area down here certainly represents a possible support / short-term target area. I don't have a bigger downside target because I'm not bearish the S&Ps right now. There's no reason to be bearish the S&Ps on an overall, medium to longer term basis. The other question was, what's the view on dollar yen? Well, the view on dollar yen from my perspective is really easy. I don't follow it. I've gone back over my records over the years in terms of the dollar yen trades that I've done. Net, I've lost money. It is probably the most difficult, not only for me, but for other colleagues I talk to. It's a very, very difficult pair to trade. I'm not saying that money can't be made in it. I'll certainly put up my chart. I sometimes track a loose wave count. You can see I haven't even updated it here. But the bottom line is I'm not going to try to give you a fancy answer, because the fact of the matter is I don't trade the dollar yen very well. And for me to give you an answer would be really disingenuous. My main focus on the FX market is obviously the euro, the dollar index, the Aussie dollar, Kiwi dollar, dollar Canada, and maybe to some extent euro sterling. For me, one of my core principles is keeping my focus very narrow. I look at trading as something that is as much of an art form as it is a science. And if I want to kind of get in rhythm and in sync with the market, I can't be looking at a million different things. I've got to be looking at 6 or 7 asset classes, or let's say 6 or 7 tradable items on a day-to-day, week-to-week basis in order for me to develop a feel for how they're trading. And feel and experience is a huge component of trading, and don't let anybody tell you otherwise. Yes, there has to be, in this case, a framework from a technical analysis standpoint that gives you the general parameters for how you're going to enter into a trade or exit a trade. But it's watching that price action on a day-to-day basis and how the different asset classes correlate with one another, or let's say not correlate with one another. That's the part that leaves the subtle clues that I feel gives you an edge as a trader. I can't tell you how many times in the course of a year I'll be looking at a setup and then I'll just be suddenly like, you know what, I'm getting long right here. And somebody will ask me, well, why are you getting long the euro right here? I mean, I know you want to be long the euro, but why are you getting long all of a sudden? I'm like, you know, it just seems like the right time. And I do firmly believe that there is that element of trading that can come to you. In fact, in any profession, there's that element of feel and experience that really play a key role. What you'll do as a newer trader, though, to stunt that development is by trying to look at everything under the sun. You know, you've got, let's say, a particular trading approach and it's kind of quiet right now. You're getting frustrated. There's no trades. There's no trades. I'm going to go over and see what this guy's doing. He's doing some trade plan B. And you run over there and you chase your tail over there for a little while. And then something's going wrong there. And now you're on to trading plan L. You never develop consistency. And the fact of the matter is there's no such thing as a perfect setup every day. You show up, the market either conforms to the way you frame and view the market or it doesn't. It's as simple as that. If you're a day trader, yeah, maybe you just make less trades that day than the previous day. If you're a medium term to like a swing trader like myself, there's days where you don't make any trades. And that's part of showing up for work. The old adage in the trading community is you make 80% of your money 20% of the time. And I do believe that's a pretty fair representation of how the markets operate. So again, you know, in a 15 or 20 minute presentation, I can't possibly share with you everything that goes on in the day-to-day trade process and trade selection that I go through, but I at least want to provide a little bit of color as to what I'm looking at, what my current forecasts are, and you know, if I come back and start doing some presentations here on a more regular basis, through time you'll be able to kind of understand how the whole trade discovery, trade management process unfolds. There is no magical solution out there, as you all know. Everybody's got their own unique approach, and people take little bits and pieces from who they learn from over the years and kind of develop it into their own unique approach, because we all have different risk tolerances. We all view the market in a different framework. And, you know, those are some things that we can look at and discuss going forward. And hopefully we'll even have the technology working so that I can hear you. I can see some of the questions that are coming in. We can just have a little bit more robust of a two-way dialogue. So I greatly appreciate everybody stopping in today and getting a sense of how I view the market. I guess in summary, the two things that are my primary focus right now, S&Ps, I'm near-term bearish with a 2936 kind of, you know, not only a stop loss, but, you know, the bearish forecast goes out the window if we get back above 2936. Dollar index looks as though we're probably going to rally a little bit more. We could probably rally up into the mid 95s, maybe up towards 96. Therefore, if you're nimble and want to be taking advantage of shorter term moves, I would be euro bearish in the near term. But by and large, for me, at least the way I approach the market and the way I frame my trades, I can't do much in FX markets right now. They're just not compelling enough or clear enough for me to navigate in and out since I'm not doing active day trading. So Michael, I guess I'll turn it back over to you. Again, thanks to you, Larry, and the rest of the team, and of course to all the clients at the Opportunistic Trader. I really do appreciate you guys having me come in and sharing a little bit about what I do with you.
Great. Thanks a lot. So that's Dave Floyd of Aspen Trading, and he's going to be joining us more regularly. Like he said, he's laying out some technical analysis and a few different ways of looking at the markets, and he's going to really take you through the X's and O's of the ways he looks at things. He's going to be coming on once or twice a week. So, if you have questions, things like that. But that is Dave Floyd, Aspen Trading. Thanks a lot.